Yeah, what are your thoughts? Because you obviously analyze the option flows and stuff. You're probably even closer than I do. So what's your sense, Brent?
Yeah, there's two things. One, I saw this chart, it's a macro chart, but it was the seasonality basically into elections. And I put it up on Twitter, but if you look at the way that the market rallies from right now to into midterm elections, it's a vicious, vicious rally. And whether that's like the equivalent of someone draining the SPR to get oil prices down into the election, maybe there's some kind of similar phenomenon trying to gas the stock market into elections. I don't really know. But the point is that I think there's just this window right now where markets tend to rally favorably. And right after options monthly expiration on Friday, we've seen call positions come in. And I heard that you were talking about skew and how there's quite a bid to call positions. And so we're now seeing like 3,800 for us as this equilibrium where it's like calls are building up over that level. And if we close up over this level, we're at 3,850 right now, then that's a really strong tailwind to markets. And you just don't want to short that, I think, right now, because there is no reason really for the market to reverse at this point. We've had puts just get demolished into October expiration. There's kind of like an all clear for like the next week, I think, into FOMC. And then the other phenomenon that is really kind of difficult to analyze on any kind of day-to-day basis is how much volume is taking place, options volume is taking place in the shortest dated expiration. So last week we measured a couple of times where 40 or 50% of the options volume in the S&P 500 was for that day's expiration. So like you come in and 40% of the volume for the S&P was just for the expiration that takes place that day. So it's pure day trading volume.
What is that in dollar notional? Would you know what that number is in dollar notional?
I mean, it's obviously billions, right? That's a great question.
I mean, it's probably in tens of billions, no?
Yeah, I think numbers are too big and I have to pare that down, but I'll have to look at that.
Didn't they buy $20 billion worth of puts and $6 billion worth of calls last Thursday? Wasn't that the total notional?
Well, when the market was on the low last Friday, when markets were on the, or last 2 Fridays ago, we're at 3,500. Someone came out and spent $30 million buying the S&P calls that expired that day, the 3,600 calls. And so those went from around $1 each, 50 cents each contract value, up to $80 a contract at one point that day, right? In the market
that was the trade of the year. That was the trade of the year, what they did basically. A one-day option.
Yeah.
Crazy.
Yeah.
They spent 30 million premium on that. Are you serious?
That's what someone, when we talked with the options expiration, so someone had sort of mentioned that. So, and some people say, well, this is risk management, right? It's dealers hedging intraday using calls to hedge instead of futures. And I think there can be some of that. I don't think this is a lot of retail flow. I think this is institutional flow.